Hey folks, this is Dr. Jeff Camarda with a Camarda Investment Strategy Update. This one for AIMS, or Allocated Investment Management System. Now, this is the asset allocated portfolios that we run besides the Caesar individual stock portfolio. As many of you know, the investment world kind of hit the fan just about exactly 1 year ago as the first drums of the trade war began a-thrumming. Regardless of where you stand politically on this, it's messed up the markets pretty royally and transformed the economic trajectory of most of the world as old deals were shredded and the major players, Trump and China, bloodily dug their heels in for a long and damaging fight, which continues as I record this in mid-February. Camarda is not among the doomsayers who see global recession in every shadow, and in fact we're quite optimistic that things will improve and keep humming. But the world got a change-making jolt, and a very, very healthy dollop of risk got thrown onto the simmering economic stew, and we began work on recalculating investment strategy nearly a year ago. It hit the fan pretty much last February with the first salvos of the trade wars, and the world, we think, has changed pretty fundamentally. After many months of work, our new strategy was finished last week of last August. There are a number of changes, including using all DFA funds on this go-around, toe dipped a bit more deeply into the bond markets, just a bit, and so on. But the really big deal is a tilt toward more U.S., which has gotten much cheaper, and less non-U.S. exposure, which has gotten a bit riskier, we think, in most portfolios. Not that we still won't have very, very significant positions outside the U.S., just not so much, and with different patterns of exposure. We really like these new portfolios, and we've been sitting on them for a long time, waiting for conditions to favor them, in our opinion. Number one, better non-U.S. U.S. relative performance. U.S. markets doing poorer than the non-U.S. markets relatively. We want to sell non-U.S. for more and buy U.S. for less, since we're tilting back into the U.S. And also poor U.S. dollar relative performance. When we sell non-U.S., we want to get more dollars, so we cash in on Chinese stocks or whatever, or European stocks. We want to get more dollars for that because the euro is stronger in this example than the dollar, so we get more dollars and hence more U.S. shares. Anyway, it works out. This transition is favored by better relative non-U.S. stock performance and a weaker dollar. And we've been watching this very carefully, closely monitoring these conditions, and both trends have been moving in the right direction. And when I wrote this, so we expect to make the changes soon, perhaps by the time you read this. And in fact, the board voted this past Monday to go ahead and pull a trigger, and we're in the process of changing those portfolios now as I record this on the 13th of February. So to summarize, we're close. Actually have made some big changes in the AIMS portfolios, including using all DFA funds, which are generally much cheaper and we think more attractive. The new models have been ready since September, but we've been watching the markets for an opportune time, which we think is upon us. Overall, we'll have less non-U.S. and more U.S. now that the U.S. market has gone down relatively more. Like Caesar, these changes are believed to better position Camarda clients for the conditions that we see ahead and are intended to help us get through it with less risk and more profit. Hopefully, you found that useful. If you have any questions, call your personal wealth advisor. Email me direct, j@camarda.com. We're happy to help, but we're very excited that we've been watching this, guys, for nearly a year, kind of picking our shots. But we're very excited to have finally found to been able to thread the needle, as it were, to get us into the position that is going to be more fruitful going forward. Thanks so much for watching. This is Dr. Jeff Camarda. Until next time, have a prosperous week.